Okay, this week I'd like to do a more in-depth analysis on all of our major asset classes. So I'm going to start with that. And what I'd like to do is I'd like to start with the stock market first. I find the stock market extremely interesting, and a lot of we are in holding patterns on so many other series. So I'm going to start with that first. Normally that's last, but I want to spend a little extra time on it. So I'm going to start there.
Richard, I'm not seeing your screen for some reason.
Oh, I'm sorry. Thank you. I hit it button and it did not show. Oh, just 1 second. Hello. 1 second, guys. Oh, Vincent's on. I guess that's not, okay, there we go. I'd like to put up the 4 cycles that we use the most. And, you know, I'm going to even use a slightly longer one, but I could use the shorter. I'll put up 5 cycles. And I think it's not going to be too unwieldy to look at them. I'm going to see. And, yeah, no, this will work. We basically are in a situation where the red cycle is a cycle that I don't often show, and it's a 20-week cycle basically. It's almost 21 week, and the important cycles in the stock market occur at around 17 to 20 weeks. And the other cycle that we follow is this 82-day, which is closer to 16 to 17 weeks. 82 divided by 5 is 16 and a half weeks. And that's the one I usually show. And then we have the 5-week cycle, and you can see I could go in, and I'm actually going to phase it the way I feel it should be phased. So I'm going to have to go in and unmark some of these so we'll come back to that. These cycles, according to the work of Hearst, see, this is a little out of phase. It's phased for this latest data. That's how Hearst would do it. But on these cycles, I generally phase them like this, and this was an inversion. So that's the reason for that in any case. So we'll put all the cycles back again. This is basically cycles I'll be using, and let's graph them again. The cycles that I basically use are, I use this longer cycle, this blue cycle, which is the 82-day. And as I say, I consider 82 and 104 close to similar cycles. They're a little bit different, but, and I generally don't use the red one, but they're telling the same story right now. That we're coming from an intermediate term bottom, and we're making an intermediate term top. Now, I want to show you one other thing here. And the other cycle of importance here is a 40-week cycle. Now, this is weekly data, which I don't usually show you for reasons. And you can see, and let's put up about 5 years so we can get a bigger time frame. It's this kind of a cycle, but you can see it gets out of sync quickly. And if we add to this the cycle, which is about a 20-week cycle, the one we're looking at, and we could also go for this 16-week. But we'll just use the 20 for the sake and try to have it complement itself. So this is this 40-week cycle. I don't trade because there are too many. Let's uncheck it so I don't have to. I want to go and make a point about it. The reason I don't trade this 40 is there's too many swings that it just misses. It missed this swing. It missed this swing. It hit this swing, and it hit that swing. So there's of 6 swings, it missed 2 or 3 of them. And so we usually then add a shorter cycle to make up for it. And we can add it now. And you can see that this one gets more swings. But again, the reason why we don't use the weekly data, it's a little too smooth, and there's too much going on in the data, which we would miss if we use these longer cycles. They're useful to know that they're there, but indeed, what's the most important are cycles less than 20 weeks, or approximately 20 weeks or less. And so what we do is we'll run the most dominant from our point of view, and I'll put those out alone. I'll remove the 2 longer ones now, and we utilize the 3-week. The blue is 5-week, the 3-week is red, and the green is 7 weeks. These are the cycles we typically use. You can see the 7-week was a little off during this period, and it's somewhat getting back into sync. But this is the 7-week swing from here to here, and you can see, like all these cycles, it's not an exact science in that sense. But all of these cycles currently are now down. And it goes a long way to our thinking. Now add to this, the other thing we wanted to talk about a little bit, add to this the seasonals. And the seasonals were very unseasonable. Well, it is daily. Clear. This was the seasonal that we thought we would get, and a low in, and we didn't. And this is not the first time. Seasonals are often wrong, and they're averages. When they're right, but if they're right 80% of the time, it still means 20% of the time they are not going to work. And that's pretty decent. Seasonal have a better average really than the cycles themselves, which are right. And if we go back and we can look at some of the cycles, you can see many of these cycles are right 58% of the time, 68% of the time, in that kind of a range. So, but in the seasonals have a better record, but they don't have a great record now. From year to year, if you go back into last year, and you can see once again, second year the seasonals were wrong. But we had come off of a very big down move in October, and exactly what we did today, another big down move in the bigger down move in terms of time between August and October. Major low came in. And so the seasonals just didn't perform very well. This part was fine in a general way. So and I wanted to bring this out because the seasonals have to be used in conjunction with technicals. And I am adding within the next 3 weeks your ability to put more than one pane of technicals on the screen. I'll give you up to 3, and so that way you can add to others, because I would say I want to be able to see the true strength, and this is what we try to use with the technicals. We want to see the seasonals put under the same scrutiny as we do cycles with technicals. You can see we showed no sign whatsoever of the market slowing down. Here we saw the possibility, but quickly it did not take it down to any low. Now I'm going to put seasonal back up. That's where I would like to see too. And you can see this was supposed to come down and was supposed to be moving down, and the market reversed itself here. And we never got any kind of a seasonal bounce. And if we again go back to 2014, and you can see we came up here, never saw it, but later on, as we got closer to into December, we had a correction. And there is a slight seasonal correction in mid-December. In fact, if you remember the end of the month research that I've sent out to everyone, I use it. There's a tendency at the end of the month for the market to rally, and in December, the end of the month rally, the end of the month rally begins about December 15th, and continues into the first week in January, like so. So I think that we have a real good shot at, this is the seasonal component of it coming down. This is a little further. This comes down right before Christmas. But I think this is where you want to buy. So what our view is that with all these cycles down, and these cycles are really down and nested nicely, and this is the same kind of down here, I think. So all of them, as you can see, down, down, down. So when they are all nested, now here you can see the 3 week was a little off, but you can see the 7 week, 5 week, and 3 week are down here. And I think that's what we're headed into. So, and that goes into next week. So I'm expecting next week to show some evidence of that. Now let's put in the, I'm going to go to the ratio adjusted McClellan. And this, we came up to 600 on the summation. And let me give some background. 600 on the ratio adjusted summation. Now the ratio adjusted part is reflected of the, what it does is it attempts to take into account the levels based upon the number, so you eliminate the effect of the number of shares traded. And I've illustrated this point several times. Back in the 20s and 30s, there were only 370 stocks traded. Now there are over 3,000. So that has an effect on the numbers, but what this phenomenon here is, when it goes to 600 and fails, then generally you get a decent sell-off, and that's what we are expecting here. And so this is another tool in it. Now we're about at on the ratio adjusted, and I'm going to see if I plot this. And now we're no longer ratio adjusted. We're at the 83 level, and it's a little below here again. I think that the market should stop. Now I'm going to eliminate all the cycles, because it's the reason I want to eliminate them. We'll put them back. You know, I want you to look at the chart. You probably have all looked at it. Look how this is a shelf almost, where we have just tightened. Now, one of these days is this. This is because we interpolate. We interpolated for Thanksgiving here, and then, but you can see this is the pre-Thanksgiving now, and this is the post-Thanksgiving. Now, ironically, both days were extremely flat, but from a historical point of view, almost a 90% chance that the market is up the day before and the day after Thanksgiving. Now, depending upon the average you choose, you might have been up both days, but barely up. The S&P was down Wednesday and up close to down 20 some odd cents, not much, and then it was flat. It was up about a little over $1.25, as I recall. So the point is that the market was very flat, and we think there's a little momentum to the upside. So we're looking for the market to have a sell-off over the next 3 or 4 sessions, and then we would anticipate that we will finally get our major buying opportunity in mid-December and have a nice rally up into the first of the year. And we will know very soon whether or not we have a new bull move. I think we do. I think we have a large opportunity to see. This failure here of the summation index, and I'm going to put and then I've got to go in and I'm going to put in 2 things. I want the ratio adjusted. The issue of, here's an example of getting up to 613, and you can see it failed just above the 500 mark. Now, Sherman-McClellan has a slightly different level on his summation index ratio adjusted. He adjusts it slightly differently than I do. Whereas, it does the same thing, but we're just slightly different levels. And we come down here, and this is the kind of move we're expecting. This was from 1698 down to 1630, basically, maybe 1625 thereabouts. So it's almost 75 S&P points, which is a nice rally. Here you can see that we came off the highs and we were at about just slightly below zero on the ratio adjusted, but we had put in a high like this and then came off and had our selling here. So we're right in this unit. This turned out to be a bull move. This was a bull market nonstop, but it was also 4 years or more ago. And when the bull market was very young, it was only back here in 2013. It was only about a 4-year bull market at that point. Now this is a very mature bull market now, and the question is are we going to just do this, or are we going to continue on to, and if we go back to 2007, are we in this kind of a category? And of course, here's another failure. It's just about 500 here. And then we had the failure at 500 and down. And this was a much bigger move, of course. This was from 1565 down to about 1415. So that's much, much bigger. And so this would lead us to a bear market. And we can't rule out a bear market, but right now we feel that this was a more like this 2011, and that we will have a new bull leg put on. How long? We don't anticipate it going all the way for another 3 years. That'd be an almost unprecedented up move in the stock market. But the fact is that we'll know right here in the next, I'd say, 3 to 4 weeks, when we see what this failure does. I'm assuming, and I'm now going to put 1 year out, and this is now the unratio adjusted, and I'm assuming that we'll come down to these levels, or maybe even this level here, and we will, if it's a bull market, and if it's not a bull market, then we're going to come back down and probably retest way down here into this area, somewhere in the area of 1925 or so. That's a big move down. So we'll know that, and again, I'm looking for and I'm going to put 3 important cycles out. I'm looking for that's the wrong cycle. I'm sorry, I misclicked. Uh, 38. Sorry. Yeah, and now we have a real fine nest of down moves. So now all the market has to do is obey them, and of course this brings us into the second week in December, and that's very close to our end of the month phenomenon. If you don't have that sheet, I have it on a PDF. I'd be glad to send it to you, but I think most people have it. And I use it, and this particular month is the only month that has a very, very early buy. Normally it's in the last week of the month. This is mid-month. In other words, what we're looking at is a move down, a move up from about the 15th of December on up into the year. Now, this is a very complex bottom, and we don't expect this to be a complex bottom. And no, I'm going to go. You can have lows like this, and well, I'm going to show you on the weekly. Just this is the kind of bottoms I'm talking about, like this. This and this is a little bit off, so I'm going to this, I think, is the right phasing of it. And so you can see that there's a lot of inversions historically here, but this is a very complex bottom back in 2011, as is this one. This is a more simple bottom, and this is a simple bottom. So I believe that what we're going to get here is a simpler bottom. Well, let's get to the future. This low, I think, is going to be a simpler bottom. I expect it to come in, and I expect it to come in approximately, once we make a top later on in the next, we'll have a very broad top here, which we're already having, and this will bring us probably, I would think, more into the last week in January, first week in February. And we'll know what we're doing, and of course, if we add one of our technicals that we use, we'll see if this true strength blue line crosses above this signal line, then we're more apt to argue for breakout to the upside, and it's all over. But I think there's enough evidence to show that the likelihood of everything being wrong is very slim. Now, it's always possible, but it's very slim. And if you look at the stochastic on this daily chart, you can see that it hasn't been able to get up to overbought conditions at all. And that, in my way, is a failure, a bullish failure, and it's going to bring more, more negative. I think it's in the neighborhood of this, or the neighborhood of this right here, and then it fails to bring it up. Now, in this case, it was very shallow, but what we want to see in any of these is the market getting up way above, and this tops out at 100, of course, and so it stayed at 100, and that's very bullish for a week or more. And then, of course, if we put out our bands, and let's just undo the oscillator, you can see that getting up to the upper Keltner band is a sign of you have some juice in the market. Here, it couldn't get up there. There was no juice in it. Here, it couldn't quite penetrate it. No juice in it. And finally here, it got above it for one session only, and it fell apart. And now here, we got above it right here, and there's lots of juice. But here, we're way away from it again, and I think this is a sign that it's got to go down before it goes up. So that's my current view of the market, and we'll go and take a look at the dollar now. If you have any questions, always interrupt. Okay. The dollar came very close to the highs that it made earlier. And those highs, they came, but didn't quite take them out. It's been my opinion that the highs of this more complicated top are in. So this, and we'll go and look at the monthly and put up the 2 cycles we typically use. We're expecting a complex top. We're not expecting this kind of a top. And it's not going to be as great as this, and it's not going to be as volatile as this. But this is a 4-year top. Here, the cycle's way off, really an inversion. I anticipate that, and of course this is a little bit old because I haven't got the last month in yet. I'm close to adding it now. I'll show you on the weekly, and then you can see. And I'm going to put the 2 cycles we use. This is a 45-week cycle, very important in just about everything. And I'm going to use the 23, and almost 23 and a half. Our view is that, and you know what? I want to phase this just a little differently. Our view is this will be the top of this 15-and-a-half-year cycle. So this is going to come in somewhere between mid and the end of January. It's been my thinking this will be the top. But you can see we've come way up, and we have another week or so to go, or more, where there's pressure on the euro, and therefore the dollar has strengthened. And with everything going on in Europe, it's easy to see why. Now let's and here's the cycles as we have them, and we can put our one of our technicals that we use out. You can see this topped out, and now we're in a trading range. And what we're anticipating is that gradually this trading range moving down into another layer down in this area here. Not a sharp, well, let's just show you the picture so we can get it. Not a sharp reversal like we had here, right, in this area, like this sharp reversal, or here. We don't see that we have that kind of a market. We think we're going to, just at the bottoms, we've had these big trading ranges, you can see. And here we had a big trading range. Even here, you can see it. Smaller, but still large trading range. I think we're going to head into that same kind of thing here. We're not going to have a big decline. We are going to have a decline, but not a huge decline. So the difference between this cycle behavior, and this cycle behavior here are going to be one of degree. As you can see, we've come here from the highest high we made in the dollar in history, dollar index, and then we made a lower high. We made, here was a lower low here, and a lower low here, and we think that we're going to be very, very tight over. And this, of course, remember, this is a monthly chart, so that's 2024. That's at least 8-9 years ago away. But remember, you get these lows early in the whole move, and so we do think the low will come here, but we don't have far to go, in other words. And so we think we divide it into two steps, and the two steps are the trading range down in this area. Then we're going to have the flush out down towards, and we don't have this, of course, this is much shorter term, but it's going to be way down the road. And that means that we'll have continued pressure on the dollar. I believe in the next 10 to 12 years, they'll change the construction of this dollar index. They should. They have the currencies they have in it are not representative of world currencies any longer. I mean, they're good, but they're just not. They're not right. They should have China in there. They should have India. Well, India's a problem, but they should have. It shouldn't be over 50% the euro. That's just not right. They didn't structure it properly after all the Deutschmark and all the European currencies were united into one, and it's not going to be able to function properly in the future. So I think once they do it, it's going to have to be wholesale. They've allowed the CRB index as well to get ruined because it's over 50% energy now. And energy is very important, but 50%, I don't believe. I think, in any case, let's look at the daily.
Richard?
Yes.
If the interest rates go up 0.25%, if the interest rates go up 0.25%, how does that affect the dollar for us?
Well, what it's going to do is it's going to strengthen the dollar, but you know what happens if but remember, it's 0.25% on the Fed funds rate, so that's not going to be accessible to to many, many people. And it's not going to affect, it's going to have a minimal effect. It's not like raising, uh, it'll have a little, it's not like raising the prime rate. It's really, what's going to happen is it's going to have a small effect on the LIBOR, and it's going to have and it'll have a bleed over effect on the prime rate, but it's hardly going to make much difference to the 10-year in my estimation. There'll be some sympathy for it, and the 30-year will not be affected much. I would look to corporate bonds to see its impact. And so if you can look at corporate bonds through the Dow bond average, and while I do interest rates, I'll show you a picture of the Dow bond average, and I'll show you the threats of raising rates. If this were a part of a plan to raise 25 basis points once, twice, three times over the next few months, it would be a different story. But clearly, they have no plans to do a series of rate hikes. And if they did, that would have a catastrophic effect. But with one rate hike, it's more a psychological tool, and all they're trying to do is give themselves some room to lower rates in the future, because this is the only rate they can lower, and you can't lower it lower than zero. Well, you can, but you're not. No, it's silly. So negative interest rates they could do, and they've said they do them if need be, but that never works for long, I'll tell you. They did that in the Great Depression, and it only lasted for a little bit, and it didn't help really. There's several cycles in the daily, and there's generally speaking, there's the almost 7 week, it's really a 6.5 week cycle, and then there's a 44. Both of them are good cycles, and I'll just plot them together because I generally use the slightly shorter one, but both of them are good cycles. This this is currently inverted, but you can see this is the 9 week swing. And well, let me make it so I have it in the right way. I don't need to take that out, and I'll put it back. That's probably as close to the phasing I would use. Clearly, the dollar has been not following this shorter cycle. I mean, it's just been a little bit off. Normally, I try to plot it. If I make this inverse, but right here, I believe this will be the top, and that's next week, and then we'll see the dollar begin to go down. So I think you could use the 44-day as a good sign. So I'm bearish, short term only. So now, when we see a rate hike, it will bring the dollar back up. And so I think that this could be right after the Fed meeting in December. I think we could see the dollar go back up. What happens is, if you can, a lot of bankers and a lot of professionals use the 3-month forward currency evaluations, and if you can put your money in dollars and get an interest rate hike, makes your money more valuable in 3 months. And those are quoted. You'll see them in the Wall Street Journal and anywhere else. And they're large amounts of money go into them, and a small rate increase will give you more interest income and a boost in the price of your underlying security. So it's a favorable situation to raise interest rates is a favorable situation it'll make the dollar go up, but not a lot. But remember, this dollar is topping, and it's topping in another 6 weeks. So it seems to me we'll have a rate hike, but I thought we'd have one before that too. Gold. Now, if the dollar is going up, gold is not going up. And we thought it might be able to get started in December, but that's when we thought we'd have the interest rate hike earlier. But they didn't do it, and they shouldn't have done it. But I thought for sure they wanted to do it, and we're going to do it. So at that point, you can see, and we'll look at the weekly. Gold and silver is just being hammered in this environment, and they keep going lower. And I want to put up 5 years so you can get a real flavor. At first, we thought these levels around 1,200 would hold, and now we got to think about 1,000. But I think it will, and this is the 17-week cycle, but we prefer the 24-week and the 47 week. These are the standard. You'll see all of these cycles are very related to one another. This shows the 47-week bottoming now, and we thought that we had a shot of producing a rally. Right now, it's just been dribbling down, and you can see this is the normal, almost 6-month moves. And I want to go and show you the daily, and I'm jumping back and forth a little bit, but I want to. This, I believe, will be an inversion, and I want to put out the seasonals. And you can see the seasonals have been all off this year. Now we're in a kind of a no man's land right now, where there's the herky-jerky back and forth. But this was off. This was okay, but this was definitely off, and if we go into the spring, our next real big shot here is in March for a low. Now, if we go back to our weekly chart, and then we'll put out one other cycle that I want to put on there, and I want to put on the annual cycle, which is almost 52 weeks, and you can see that we should have had a rally from the summer on up into December, and we didn't get it. And now we have to go all the way here, and this is June for this annual cycle, and we should have another rally then. But this is clearly going to be an inversion. So that's, and of course, the cycles that we're using are these, and you can see all of this is just unseasonal, it's uncyclic, and it's a function of the dollar. And so if you're really looking at gold, you got to look for that dollar top to come in. The dollar's got a top, and that if the dollar doesn't top, and it doesn't start going down, gold isn't going to do anything. It's not going to, but we believe that we're very close to a top in the dollar, and we think that we believe that gold will go up once the dollar starts topping, and we believe it will be the 7.5-year cycle will come a little late this year, but it'll come. And that 7.5-year cycle is across the board in every commodity. And that's important. But remember, we expect gold to turn first before the other commodities. gold doesn't turn, the other commodities like gold need the dollar to come off its high horse. Okay, that's what we're looking at with gold. There's not a lot to say about gold until we get to the dollar moving. Now, I want to show you the Dow bond average quickly because it's a here we are. I'll put a weekly chart up. And don't want a 3-week cycle. I'm going to put up a 32-week cycle. This is what we are going to be looking for. I believe now these are prices, and I expect that these prices will fall after a rate hike, but not seriously. You can see how far they've come up, and if I put, that's the trend that we've seen. Here was the first threat of rate hikes here, and now we are in the next threat period, and I would keep my eyes on the bond average to lead the way. And if there's a big effect on this bond average, then I would anticipate you saying, well, you got to be very careful because this interest rate hike might have other ramifications. I do not expect this. I expect the bond average to be in a trading range, just like the long bond. Well, hit the wrong key. I'll go back. T-bonds are going to be the least affected by the interest rate hike, assuming we get one. And that's because the short end of the curve is where the interest rate hike is going to affect the most. The absolute long end of the curve, like the 30-year bond, is going to be affected the least. And we'll show you on the, now the, we're going to put up the 22, but the 20, we can use this 20 just as well. Matter of fact, we'll just keep the 20. It's just going to be fine. Both of them are basically the same cycle. And you can see, and then I want to put in the longest cycle that we look at here, the 96-week cycle. So almost 2 years, not quite. We'll plot that. And we'll phase that the way we usually phase it, which is like that. And let's put it 5 years. And you can see there's a hint. It's almost like this is the rhythm, and which should be longer. And then we'll put this in and plot that. And individual, that's what I want to say. Yeah, so we're here, and so we anticipate bond prices should rise, but that we would anticipate that would mean that we could see a rally in bond prices, and I think this will not go all the way. I think this will be an inversion, that with an interest rate hike, we'll see it turn down here when we get into December, of course, and then this will be, which is due in January, this will be a bottom in prices, and a high in yields. We don't expect a major move in yields over this rate hike. And this rate hike isn't going to, what you need in rate hikes is you need several of them. Now, if we go back to, well, we don't go back that far. We go back to 2007. Well, get there. Yeah, here we are. You go back to 2000, early 2007. We had some rate hikes, and you can see that we had a nice downtrend there. And then we started hitting the economic problems, and yields, of course, in the midst of the crisis went sky high, flight to quality. The stock market was sunk and came all the way down into the March low here in the stock market, and then rallied again, and then finally went into major trading ranges. The stock market straightened itself out. And then we had the quantitative easing and all that business, which had affected everything. So right now we are at, and if I put up 12 years, you can see the whole, right now we're at the highest levels that we've been in some time. And we're coming into a trading range. Now this last trading range, which had some significant ups and downs, was between 2011 and 2013, almost 2 years. And this one has been going from approximately March of this year. And so we think it could go all the way into 2017 in a similar kind of up and down range. We don't think we're going to have this kind of a move down. We don't think we're going to have this kind of a move down, or even this kind of a move down. We think we're going to be in a holding pattern like this, because we're assuming this is going to be a one-off raise in rates. And if that's the case, we're not going to have a big move down. So that's the weekly. Now on the daily, this is the 7-week cycle again, same as like stocks, and I guess I have 2 cycles there. I don't want a 12 again. And you can see this is the 7-week rhythm. Now it's the same 7-week rhythm in stocks. It's similar to the rhythm in gold. It's similar to the rhythm in the dollar. They're all very similar. And again, and if you look at the seasonal pattern, hit the wrong thing. Okay, I have to fix that. Okay. If you look at the seasonal pattern, you can see how the bonds move in their seasonal way. And right now, bond prices are due to come down seasonally into mid-December, and that's approximately when we expect the stock market to turn. And then we go into some no man's land here again in bonds, and generally we expect a high in yields by the time we get here at the end of December. So that would indicate that we'd likely see an interest rate rise. Now, a high in yields will mean lower prices, and that's what we expect here. And that could move its way into into the first week in January. So that's kind of what we're looking at right now. And I'm arguing that we're ripe for an interest rate hike, but it's going to have a minimal effect. Now, a minimal economic effect. I can't know what the psychological effect's going to be. And I'm not sure how it's all going to wash out everywhere. Plus, you have all these other wild cards going on. Who knows, I hope the whole Russia-Turkey thing calms down. And I hope that somehow we develop a more rational country. It seems we're getting worse and not better, so we'll have to see. So anyway, that's pretty much what I wanted to accomplish for today. I'll take any questions or comments from anyone.
Thanks, Richard. Good summary.
Okay, thank you guys. Everybody, I hope, had a wonderful Thanksgiving, and we'll talk to you next week.
Bye-bye now.
Bye.